Hello, and thank you for joining our call today. We are happy to have you here. My name is Carla Dominguez. I am a licensed attorney and a private wealth advisor at Westwood Wealth Management. I would like to introduce to you my teammate, Shalitha Smodik, who is a private wealth advisor and a certified financial planner. Shalitha is currently studying to get her PhD in financial planning. Thank you for joining us today for our topic, Navigating Trusts. Which type of trust is right for your situation? This topic comes up a lot in our discussions with prospects and clients, so we decided to address some of the questions in this forum. In today's call, we will be discussing trust basics, terms, definitions, and nuances that are applicable to most trusts, common trust types. These are the trusts that we have come across in our careers as advisors. And lastly, key considerations to keep in mind when choosing a trust as part of your estate plan. I will now pass this over to Shalitha to start us off on our discussion.
Thank you, Carla. So the first thing I wanted to talk about today is, frankly, what is a trust? So a trust is a fiduciary arrangement where a party transfers assets to a third party to hold on behalf of a beneficiary. This concept is actually a very old one, dating all the way back to ancient Rome, and then it was later translated into English common law in the 12th century, where landowners would leave to fight in the Crusades and then entrust others to watch over and manage their property until they returned. Throughout this presentation, we're going to discuss several different trust types. However, with any trust, there are about three key major players that you'll see come up in any kind of trust configuration that you're looking at. The first is a grantor, the second, a trustee, and the third, a beneficiary. The grantor is the individual that creates the trust and then transfers property into it. A trust could have more than one grantor, and this is something that we often see when a couple establishes a trust, so that a trust would have both spouses present as people who have put money or property into the actual trust. The trustee is the third party that administers the assets transferred into the trust. A trustee can be an individual or a professional corporate trustee. At times, the grantor could also serve as the trustee, and I'll show you an example of that a little later in this presentation. A trust could have more than one trustee, and that would be referred to as co-trustees. And a common way that you see that happen is that a trust could have one professional corporate trustee and then one family member as a trustee. And this is a really good configuration because it allows you to get the expertise of that professional help, but also gives you that personal touch from having a family member also involved with administering the trust. Finally, every trust has a beneficiary, which is the person that benefits from the trust. The beneficiary of the trust could be a whole host of different types of people that you have relationships with, or it could also be a charitable organization. So anytime you're working with the trust, there's some common terms that you'll come across. So first, is the trust revocable or is it irrevocable? A revocable trust is a trust that can be altered or changed while the grantor is living, whereas an irrevocable trust cannot. Also, trust can be established during life, which is referred to as inter vivos, or through a will at the death of the grantor, which is called testamentary. As we walk through some of the most common trusts that we see in practice, you'll see a lot of these terms pop up, and they're really not throwaway terms. They're things that help to describe specific aspects of the trust, but without, going into major detail of what exactly is going on there. So they're important to keep in mind. So the first trust that I want to talk to you guys about today is the marital trust. This by far is one of the most common trusts that I see on a day-to-day basis. The marital trust is an irrevocable testamentary trust established for the benefit of the surviving spouse. These trusts could also have provisions where the descendants of the surviving spouse or of the deceased grantor could also benefit from the trust. And that's something that would just be written into the formal trust agreement. Some key advantages of the marital trust is that it takes advantage of the old unlimited marital deduction, which means that all the assets pass to the spouse free of estate tax. This becomes especially important if your estate is over the current estate tax exclusion of 11.58 million. A marital trust, however, does not eliminate estate taxes over the exclusion amount, but it can defer estate taxes until the death of the second spouse, where the second spouse could then use their remaining estate tax exemption. So this is really maximizing that benefit. This trust also offers protection from creditors and then also from any future spouses that may come into the picture later. When the marital trust is used alone, though, for families that have a taxable estate over 23.16 million, quite high at the moment, it may result in not fully utilizing the estate tax exemption of the deceased spouse. So currently, there is a provision that can help with this, and that is called portability. And this allows the surviving spouse to use the deceased spouse unused estate tax exemption. And that's a really helpful benefit that we have right now. However, if the surviving spouse remarries, access to the deceased spouse unused exemption is forfeited. And so to protect against this, this is one of the reasons that often if you have a marital trust, you see it used in conjunction with another trust, and that is called a bypass trust. So you may also hear a bypass trust referred to as a credit shelter trust or also a family trust. And all those different terms are generally referring to a similar type of trust. So this trust allows a grantor to use their estate tax exemption to fund a trust during the or through where they request any additional assets to their spouse or to a marital trust. So this allows that grantor to use up all of their available estate tax exemption before then also getting the benefit of the unlimited marital deduction. This trust does add some complexity to the estate plan. So you're going from having no trust to one trust to two trusts, and it may also be seen in some cases as redundant due to portability rules, but it really does ensure that your estate tax exemptions are maximized by minimizing your overall estate taxes. And then, of course, this type of trust still offers that helpful creditor protection. The next trust I want to talk to you all about is the Revocable Living Trust. And this is another trust that I see commonly used in any type of estate planning. And you may also hear this trust referred to as a management trust. So this is a revocable trust that's created during the lifetime of a grantor, and it's known for being very flexible, and it allows the grantors to retain control of the trust. This is an example, as I alluded to earlier, of when a grantor may act as a trustee of the trust or may be one of the co-trustees co-administering in the trust. The greatest benefit of the Revocable Living Trust is continuity of the management of assets upon death or the incapacity of the grantor or grantors in some cases. This can be especially useful for a single or widowed person as a plan for end-of-life care. This trust also keeps assets out of probate, which provides some privacy and can be really useful for families where maybe the next generation isn't necessarily equipped to or interested in administering all of the family assets. So you could have a corporate trustee come in and help with that. However, the main disadvantage of the Revocable Living Trust is that all of the assets really need to be titled to the trust, and the trust needs to align with your will or your other estate planning documents for this trust to truly be effective. Otherwise, it just simply doesn't work as it was intended to. This trust also does not provide creditor protection or save on income taxes or estate taxes. And that's not really a flaw in the design of this trust, it's just simply not what this type of trust was intended to do. So now that I've walked you through some of the most common trusts that I see in practice, I'm going to turn the mic over to Carla to talk with you about some more complex trusts that we see as well.
Thank you, Shalitha. Another common trust that we have seen as advisors in the field is an intentionally defective grantor trust. And this is an estate planning tool which is used to remove certain assets of an individual from their estate for estate tax purposes, but not for income tax purposes. And don't let the name fool you. This is not defective at all. The defective part relates to the income tax treatment for these trusts. It is basically a grantor trust with a built-in flaw that ensures the grantor continues to pay income taxes on it. It is most often established for the benefit of grantor's spouse or descendants. It needs to be established with a non-interested party as trustee to avoid its accidental inclusion in the grantor's estate. Most importantly, the trust instrument must contain a particular type of provision which will make it effective for estate tax purposes, but defective for income tax purposes. And the three most commonly used grantor trust provisions for these type of trusts is reacquiring trust assets or substituting them, where basically the grantor can reacquire assets initially placed in the trust and swap them out for assets of equivalent value. Secondly, borrowing from the trust. This gives the grantor or a non-adverse party the power to take loans from the trust without adequate interest or security. This is a power that must be retained by the grantor and not given solely to the trustee, however. And lastly, changing of the beneficiaries. A defective grantor trust could give the grantor the power of disposition, which means that the grantor retains the right to add non-charitable beneficiaries or direct distributions to existing beneficiaries in the future. We've seen these types of trusts funded in two main ways. One is a completed gift. Usually a gift of appreciating assets gives the most benefit. The income from those assets can be retained by the trust and passed on to the beneficiaries, and the grantor avoids additional transfer taxes on the asset, even if there's a significant increase in value. And the second funding method that we have seen is an installment sale, where the grantor sells the appreciating assets to this type of trust in an installment sale. The grantor receives an interest-bearing promissory note payable by the trust. But because this is a grantor trust, no tax is due on the gain from the sale, because the grantor is treated as having sold something to him or herself. So he keeps the ability to maintain an income stream from the installments or the interest payments while allowing the trust to grow with the value of the trust principal for the beneficiaries. So we've talked about the advantages of this particular type of trust. It removes the assets from the grantor's estate, gives beneficiaries the benefit of the appreciation without incurring transfer taxes. Income taxes are paid by the grantor, which further reduces the value of the grantor's estate. And these tax payments are not considered additional gifts to the trust or its beneficiaries. There is no recognition of gain or loss if the grantor engages in a sale of assets to the trust. And the grantor is also granted the ability to control, to a certain extent, the beneficial enjoyment. Most irrevocable trusts do not include a grantor trust provision like this because it requires the grantor to relinquish all rights and powers with respect to the trust. Now keep in mind that the grantor trust may become undesirable at some point, whether due to the performance of investments, the potential sale of highly appreciated assets, or merely due to the lapse of time. It may no longer be financially feasible or desirable for the grantor to continue paying the tax. This is becoming the norm as our markets change. So the good news is that most grantor trusts are structured to allow the grantor status to be turned off or on. But this is by no means a simple flip of the switch and should not be used in this way. Depending on the specific situation, it may be possible to turn off the grantor's trust status and the grantor owe no taxes. But consider the sale to a defective trust. If the sale to the trust by the grantor was of appreciated assets in return for a note, and the obligation is still outstanding at the time, the grantor trust powers are turned off. A portion of the previously avoided capital gains tax will become due. And then last, but certainly not least, we have quite a few clients that are charitably inclined. And if you are charitably inclined, setting up a charitable trust is something to consider. These trusts give you flexibility and control over your charitable contribution while saving income tax and maybe even estate tax dollars. There are two types of charitable trust: charitable lead trusts and charitable remainder trusts. A charitable lead trust first distributes a portion of its proceeds to a charity for which the grantor will receive a charitable donation tax deduction equal to those payments, and the remainder is then distributed to the grantor's beneficiaries. A charitable remainder trust, the grantor chooses to receive income from the distribution of non-income producing assets placed into the trust first. Here again, the grantor receives a charitable donation tax deduction based on the present value of the remainder of the assets earmarked for charity. At the end of the term or upon the grantor's death, the chosen charity receives the assets. One thing to keep in mind is that any charity selected to be funded must qualify with the IRS to receive charitable deduction. So we have seen the funding of these two charitable trusts in two ways. One is to set up a donor advisor fund. You don't have to choose your charitable beneficiary when you create your charitable trust. You can create a donor advised fund to direct payments from a charitable lead trust or a charitable remainder trust to whatever charity or charities you eventually select. That gives you the flexibility to change your mind about a charity or about a charity. Or you can replace assets for beneficiaries. You have choices for the income a charity remainder trust creates for you as the grantor from the sale of your non-income producing assets. Those looking to leave an inheritance for the beneficiaries can buy a life insurance policy and use the income produced by the charitable remainder trust to pay for policy premiums while using the remainder to fund charitable intentions. So, advantages of charitable trusts: if you set them up correctly, they can reduce estate taxes and preserve the value of highly appreciated assets that are used to fund these trusts. With income tax deductions, the grantor would obviously receive an immediate income tax for the portion of the contributed assets that will eventually go to charity. Estate tax reduction: transferring assets to a charitable trust excludes them from the grantor's taxable estate upon his or her eventual death. Preserving highly appreciated assets: contributing these type of assets to a charitable trust preserves their value and avoids capital gains tax that the grantor would have incurred if they had sold these kinds of assets on their own. And it could create income. If the grantor needs income, but the assets don't produce any, they can place the assets in a charitable trust. The charitable trust can sell them without incurring any tax liability, and it could provide a stream of cash back to the grantor until the remainder goes to the charitable organization. A couple of things to keep in mind is the cost of setting up and maintaining the trust. And also, once you move your assets into the charitable trust and it sells the assets, distributes them according to the trust type and terms that are selected, the trust is irrevocable. So if the grantor were to suffer a personal or business financial loss, they would be unable to obtain the funds placed in the charitable trust.
Thank you, Carla. So in this presentation, we've really reviewed a few commonly used trust types, but there are so many more trust and estate planning techniques that can be utilized for you and your family. For this reason, when you're considering creating a trust, it can be very helpful to work with a financial advisor like myself or Carla and an estate planning attorney to walk you through all of those options. A few key considerations to think through when you are looking to create a trust are: what is the primary goal in establishing the trust? Do I have a taxable estate? When do I want to transfer assets into the trust? And also, what do I want the trust to be used for? Who do I want the trust to benefit? By taking some time to truly understand your goals for creating a trust, your financial team can ensure that you're creating a plan that truly suits your needs and the needs of your family. With that final thought in mind, I want to thank all of you for joining us today for a discussion about navigating trusts. And if you have any questions or would like to ask us to review your estate plan or have those types of discussions with you and your family, please feel free to reach out to your Westwood Wealth Advisor. I hope you all have a wonderful day.